Hey, good to see you, my investor friends. This is Lucas here. Now, in today's video, I want to talk about something that, lately there have been people reaching out to me asking, Lucas, I have X amount of money, and what did you do to start out, to become an investor and get passive income? Now, passive income, of course, is the magic word. Passive income. Why is this the magic word? Well, I'll tell you this. Passive income, the idea is very simple. What you would like is that, while you are sleeping, not working, the moment you're doing nothing, yet there is something on the background making money for you. And passive income is the way, not through a business. Having a business is still active income. You've got people out there who make money for you, which is a great thing, but that's not called passive income. Passive income is really, when we check out on Wikipedia and when we check out on Google, passive income is when money works for you and money works for more money. That's the idea of passive income. So, when you're sleeping or when you're chilling, when you're not doing the actual work, just still, your money is growing by itself. That is the idea of passive income that I'm going to talk about today with you. Because, a lot of people have been reaching out to me lately asking, Lucas, it's cool to see that you're making, that you are making your own wealth, but how can I start out myself? Now, I've been replying all of these messages to these people, and that's why I thought, like, what, I'll just make a video for you today, how you can grow and actually create your own passive income stream. Now, you have to take this as, it's not that the moment you start with $1,000, because that's the number that I use today. It's not that the moment you start with $1,000, in a month time you will be doing like this. It's not like this. Passive income needs to grow over time. You gotta see like this. Hey, if you would have $1,000, if you would leave it in your pocket, it doesn't do anything. The 5 methods that I'm gonna show you today are at least going to get you a certain return, which is a great thing, and that is all what we want. Because in the end, money needs to grow. Money needs to work by itself. That's what you want to do. And the first thing that I want to talk about is the dividend stock. Dividends stock. So we've talked about dividend stocks before, and you got to see it like this. So what happens is you got to invest your $1,000. You're going to invest your $1,000 in a certain company, and this company will pay you an annual percentage. For example, if we take a look at Apple, and if we Google Apple right now, you could see that the annual dividend interest rate that you would get is 1.1%. Meaning with your $1,000 at the end of the year, they would give you $11, which is a total good idea, right? Which is, like I said, it's not a lot, but it's a way to make money. Now, $11, of course, dividend stocks tend to pay out like 3 times a year, 4 times a year, like every 3 months. They tend to pay out. Every quarter, they'll pay you their amount of dividend stocks that they promised you. Now, over that $1,000, you would get $11 in the end of the year, which, is $275 per time. Now you might be thinking, wow, it's only $275 per quarter. So I have to wait 3 months for only getting $275 back? Yes, that's one, because Apple only has a dividend of 1.1%. And of course, you got to see it like this. You didn't do anything with the money. The only thing what you did is you put the money and you bought, for $1,000, you bought dividend stocks for it in Apple, and they're paying you back. And yes, this would take a while for you to, grow your money back in the end. Now, when we took, for example, Coca-Cola, when we take a look at that, for example, they have about 3.5%, which is a lot more already. So that means you would have over, 3.5 is $35. That's, hey, it's already $35 at the end of the year instead of the $11 because, it's 3.5%, which comes down to 8.75. So it's like 8.75, $8.75. It's still not a lot, but that's, every quarter that's what you get. And when we compare, for example, when we take a look at the Bank of America, they pay out, let me take a look, that's 3% what they're giving you. Now, you got to see it like this. So if you buy stocks, if you buy dividend stocks in Apple or Coca-Cola or the Bank of America, this is the portfolio of Warren Buffett. But that's not only it. We're not only doing for that amount of money. Now, there are a lot of people who live of dividend stocks. They make a passive income, but maybe they bought for $10,000. They bought certain stocks, and with that, they could just ride the wave and think like, what? I don't have to do anything because these companies will take care of the income that I get. Well, the thing is also like this. You got to see it like this. We're not only doing for the, I don't know. I'll just take a look. Let me take a look. This is 875, and this is 750. So we're not doing it for the two something, the 875 or the 750 that we get each quarter. We're not doing that only. We also bet on the idea, of course, that these companies will also grow each year. And that's the idea as well. For example, like if one of these companies, so if the company, for example, grows about 8% each year, what happens to your $1,000 is your $1,000 also grows 8% a year. So your initial $1,000 that you invested, all of a sudden, after a year, turns into $1,080. And you didn't invest any more. But the value of that stock grew as well. And with that, of course, the prices will also grow, even if the dividend stock percentage would stay the same. And of course, that also sometimes changed. But, if Apple would say, hey, no matter that we've grown, we stick to the 1.1%. That also would mean that your 275 all of a sudden would grow as well. And that's what we want, because, all of a sudden this would turn into, 297. And the Coca-Cola one would all of a sudden turn 945. And of course, the Bank of America all of a sudden would turn to $8.1 per quarter. And all of a sudden, this is what we're waiting for. So, hey, it's not a lot of money maybe, but it is a lot better compared to when you just leave the $1,000 in your pocket for a full year. Nothing happens. But here, all of a sudden, money starts to grow. And this is the first one, okay? So dividend stocks is what you could do to start your journey on getting passive income. Now the second one, and this is what I love very much, are the index funds. And I'm very fond of index funds because index funds, you got to see it like this. If you would have to buy all the stocks within the S&P 500, it would take you a lot of time to click on one of each of the stocks saying like, I want to buy, 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 I want to. It would take you a lot of time and it would cost you a lot of money because every transaction, every action that you need to take will be charged, you'll be charged money for. And that's why they've got something called the index funds. What happens is that there's a portfolio manager and he has a bunch of these stocks in his portfolio that he takes care of, and you just buy into his, into the portfolio of this fund manager. And all of a sudden, you buy one fund, and this is going to be, somebody's checking out this, somebody's taking care, he's managing this fund. So there's a fund manager. There's a professional fund manager, and this is different compared to those, of course, who actively, the hedge funds, those who actively take care of a stock. These are more passively. These guys just check out the fund as well, and they can only buy or sell only once a day. So what happens all of a sudden is there is a guy who would take care of all your funds, and the only thing that they would charge you instead of, the active investors would charge you maybe something like 2%. These guys maybe only charge you 0.05%. For all the work that they do for you, you only have to pay them 0.05%, which is a great thing. And the only thing is this. So I use index funds to buy stocks on the stock market. And with this, so this is what I do, I make at least an 8% return per year. And that's the interesting part. Because in dividend stocks, as you could see, the numbers would be somewhere between 1 and 3%, which is not bad. if you still leave your $1,000, of course. If you leave your $1,000 in your pocket, or in an old sock, if you put it in an old sock, it doesn't grow at all. But all of a sudden, if you start investing in index funds, you could get up to 8% or even higher, depending, of course, what strategy you use. Now, in index funds, it's very easy. Like Warren Buffett says, the moment I pass away, I tell my wife to put all the money that we have in S&P index, so in the S&P 500 index. That's what you could do. It's a very simple way. There's no strategy to it. You could just leave it there. And as you can see, most people see over a past 10 years, S&P grows on average for about somewhere between 8 and 10%. So that's something cool. So if you leave it in for 10 years and you have an average somewhere between 8 and 10% growth, dude, that's a lot more compared to this dividend stocks. But this is not money that you would get every quarter. This is the moment you take it out, so the moment you sell your index fund, so the moment you sell your fund, you would cash out. Whereas on dividend stocks, you could already live off this every quarter of the year. If you already know what your expenses are, about every month, you could calculate this and you could say, this is the amount that I need to buy in certain dividend stocks, and that's the income that I will get every 3 months. So this is slightly different, whereas this will return as an income to you every 3 months. Index funds do not. Index funds, you just, you buy a certain fund and you have to stick with it, but it does grow over time. And for example, if you can leave it in for 10 years, take it out of 10 years, and in 10 years time, the stock will, the stock index will always grow. And that's a cool thing as well. But yes, if you want to get a lot of percentage and high return, you will need to have a certain strategy. That is what I do. I teach a course called Grow Your Money, and I'm teaching you how to buy and select the right funds and the right stocks so that you can grow them over time, but also those that will make you money also in the short term. So you have short-term investment and long-term investment. Okay, let's continue to the next one. So number 3 is the rates. And what are rates? So this is real estate investment trusts. So there are these platform and companies that are publicly listed though on the index, on the stock market as well. These companies, what they do is the moment you invest your money with them, they will buy real estate investments with it. So they're going to buy up restaurants, they're going to buy up companies, they're going to buy up certain real estate or properties. And what they will do is you don't have to take care of all the tenants. You don't have to have all the headaches of thinking, I got to go to the bank. I got to think I got to loan this much money. I have to think of a certain business plan. In the real estate investment trust, what you actually do is you just bring them a certain amount of money. You just bring them a certain amount of money, and what they will give you is they will give you a certain amount of return. And this return could be somewhere between 4%, but also somewhere between 12%, depending on which project that you kind of want to invest in as well. Because in most cases, what you tend to see is that you're allowed to select where your money goes to, because you could say like, I want to invest in a business, and and I have $1,000. So the moment you invest $1,000 in that business, you will get 4%, for example. But if you say like, I have a certain, this rate company, they have a certain business that is, it could be a bit risky, but they need the money very soon and they'll pay you back in maybe 3 years' time. It could be very risky. And they could say, because it's a bit risky, we'll give you more. We'll give you more return, if the business does not fail or go bankrupt. Because the moment it goes bankrupt, there goes your investment as well. Okay, so that is the thing as well. If you choose a project within their investment fund, hey, all of a sudden you get less return, but most likely you'll get a loan back paid in maybe 3 years' time, or maybe 5 years' time, or maybe 10 years' time. That depends on the project that are most likely that you will want to select with this company. Now, I always call this as a certain platform. I don't know if you have it in your country. In our country here, we've got something called the funding circle. Funding circle is kind of the similar idea. They need a fund, and within that fund, you can select what you want to do with your money. And you could start off with amounts like $1,000, which is very easy. And yes, they will make you a return. Like every month, they will pay you 1/12 percentage, a certain percentage of the annual return that you would get. This is a certain way to do that, and it's a great way. And this is also how I started myself as well. And actually, just to be honest, actually, I did all 4 of today's, and not number 5 yet, but I'll get to that later on. But in 4 out of 5 ways of creating passive income, I've done it all myself. And currently, I'm even teaching the index fund as a course. If you're interested, you can check out my website, of course. Number 4 that I want to discuss with you, of course, is bonds. And yes, the first time I heard this, I was thinking about him as well. Not Bond, James Bond, not that Bond, of course, but the bonds that, it's like a little piece of paper that, the IOU thing idea, that's the same idea of a bond. Now, that's a very simple explanation of a bond, of course. It's actually just a loan. You loan people, and in this case, it's very often is that government or a state or a certain company. You loan them money, and they will pay you back. So loan, it's very simple. What happens is they will have to pay you back in a certain set amount of time. So, for example, it could be a loan of a year or 3, or maybe 5, or maybe 10, and they will pay you back because you have that piece of paper that says, you with $1,000, you've loaned it to them, and they're going to pay you back in a certain time. But what you see with bonds are very safe. Most of the time they're government or from the state or the country gives out a certain receipt saying like, we need some money. Who's going to loan us some money? What happens is because it's super safe, because in 9 out of 10 times these bonds will always pay you back. But the thing is, it's a lot lower. It's somewhere between 2 to 3%, which is not that much compared to the dividend stock. But it's a different idea. Dividend stocks, you buy it, the company grows, so your value of your stock grows. And of course, you get paid every quarter. Whereas on bonds, you don't. You don't get paid every quarter. Bonds, could be, you get paid once a year. Or, but you'd get paid, but the moment you get paid, they pay off you. It pays off, and you get a certain percentage. So it's on top of it. So it's not gonna grow over time or anything. It's not that it's gonna grow and you know what? Because you've been with us for 10 years, it's not like that. Dividend stocks do happen like that. So in 10 years' time, like I said the other day, if you have a 10% return after 10 years with a dividend stock, you still owe you $1,000. But as bonds, they would pay you back since it's a certain loan. Now, if you want the money back right away, you could, of course, sell that piece of paper from the bond. You can sell it off to somebody else, and then somebody else would give you the value of the bond, okay? But like I said, so the bonds are very low interest. So they're not that high compared to rates where you could get up to 12% or index funds that actually start at 8%. Okay, so that's a lot different because yes, the amount of risks that there are related to these bonds are also a lot lower because like I said, it's a lot safer, and that's very good. Now, like I said, all these 4 methods I've done myself in the past as well. And in the end, what I've noticed is, sticking to the index funds is a lot nicer because, I've created a certain strategy that will give me at least 8% return annually. You have to think it, even in a crisis time, yes, even during a crisis time, getting 8% or more, that's a great way. And number 5 is one of the ways that I'm trying to do right now, I'm busy with this right now, is YouTube. If you would be able to invest $1,000 in YouTube, you could get all the material, like the camera that I'm using, but also my mic and professional stuff like this. Because yes, I have a wired mic. It's wired. It's over there. It's wireless, and it's so all these professional stuff you could buy with $1,000, but you gotta invest your time, and you gotta think of content that you want to share on YouTube. But the moment you can invest $1,000 in things like YouTube, yes, all the videos that will get, that you will get in return, you start to monetize them. What happens is that all the viewers will see your videos, will see all your content, And the moment you've got 1,000 subscribers and over 4,000 hours of material, YouTube will say, hey, you know, you can start here with making money on ads. And all of a sudden, you know, you could leave it there for years to come. And YouTube would continually, you know, give back money to you because, hey, they're using your videos to post ads and show ads to other people. And that's how you and they make money at the same time. Return on investment? Well, I think on YouTube, they say that's a lot of return. Now, I haven't done this yet. I know that I've started my own YouTube channel just lately. And yes, I've started to post my own material as well. So I'm learning to do that myself currently, you know, next to all the things that I've tried in the past as well. Currently, my index funds is the best bet that I have since I still make at least 8% per year on annual return, which is a great idea next to the side hustle that I'm trying to build on YouTube as well. Hey, if you like this video, this is a great way to start your $1,000 investing and start making that passive income. Because, hey, we all want to... The thing is with passive income is that you don't want to have the instant gratification. You know, it's not that you're saying like, you know, give me my money back. This is the money that you think like, you know what, I can miss $1,000 and I want to make money back. And I want to have the reward that is in the far future they could take back all the time. And you got to see it like this, because Warren Buffett always said, because if you would have invested with the S&P 500 with $1,000 in the 1950s, you would have over $5 million today. And yes, that would take 70 years. But hey, from $1,000 to 5 million, well, that's quite of a difference. And yes, that is only because you invest and leaving the money there with index funds. And that's why I already started a decade ago with index funds. That's how I started to make my own money passively and how I created my own wealth. Hey, thank you very much for watching today's video. Of course, if you like this video, please give me a thumbs up. And if you haven't subscribed to the channel yet, please consider subscribing as well. If you haven't shared this video with your family or friends, and you believe that they need to watch this video as well, please do so, because that's the way how we grow our community. Thank you very much for watching, and I'll see you on a next video. Bye-bye.